Welcome back to Market on Close. Just a few minutes left in the trading day here for this Wednesday. It is time now for the big picture. Let's welcome in our guest from Charles Schwab. Very pleased to say I'm joined by Liz Ann Sonders, who is the Chief Investment Strategist at Charles Schwab. Thank you so much, Liz Ann. It's lovely to speak with you. This is our first time having a chat. Yeah, and I'm just wondering how you and your team are watching these markets right now, because it's like nothing more to see here seems to be sort of the attitude that they're taking, particularly when you consider the tensions that we saw flaring up in the Middle East.
Yeah, certainly a nothing to see here attitude. And that's in part because there was the digestion time over the weekend and the fact that by the time markets opened on Monday morning, you had seen the reversal in oil prices. And that had been the most significant concern that I think could have had a more sustainable impact if you had seen the spikes persist in oil prices. And that was based on fears about the Strait of Hormuz potentially getting shut down. And none of that, at least at this point, has unfolded. What I think is interesting, though, is that what this ostensibly should do is put trade policy back on the front pages, and we're kind of moving very quickly toward the July 9th point at which the 90-day extension or delay of the reciprocal tariffs announced on April 2nd kick back in. So I think there may be some complacency now built into the market based on what is still a pretty cloudy outlook.
Yeah, it's interesting you use that word complacency, because there's been a lot of ways to describe this market right now as far as durable and resilient. And so that's certainly an interesting perspective, particularly because you did see sort of trade policy taking a bit of a back seat given the geopolitical tensions, as you have pointed out. Your colleagues also had suggested to me that sort of July 9th was going to be the next catalyst. How are you watching that?
Yeah, so I think, none of us can gauge in advance what policy announcements are going to be or the manner by which we get them, other than assuming they will come via social media posts. So I wouldn't try to game that. What we can do is gauge the so-called setup. So I think the setup heading into April 2nd was one of, to use the word again, complacency. And that meant that you had more downside when you got what was very negative news on April 2nd of much more significant tariffs than what had been built in as a base case. But then a week later, literally a week later, at those intraday lows on April 9th, the setup was one of washed out sentiment, washed out breadth. Market was incredibly oversold. So you get what was really just incrementally positive news with the announced delay, not a never mind, we're not going to put these tariffs in place. That was enough to start to power the market higher. So now, as we head into July 9th, the setup is one maybe not of extreme complacency, froth in the market, but maybe a little bit of a risk to the downside if we get some sort of negative catalyst. It's also the case that where there's might be a positive catalyst, which is second quarter earnings, analysts may have yet again set the bar a bit too low, given that they didn't extrapolate stronger first quarter earnings into estimates for the remaining 3 quarters. But by the time second quarter earnings season starts, we'll ostensibly know what has happened on July 9th. And I think corporate outlooks in that backdrop will be incredibly important. So to me, that's the next big potential sort of narrative change, is what happens on or around July 9th.
No doubt about it. Certainly as far as a catalyst is concerned for these markets. It's interesting you talked about, what corporates are thinking about, because, I was speaking to BlackRock a little earlier, who was certainly suggesting that the next leg higher could be based on earnings, expecting continued strength there. But it really does come down to what sort of shape some of these trade deals take. And no doubt that factors, of course, into the Fed's decision as well. So how are you watching that based on, the data that we have got and the data that we're expecting to get, particularly with the PCE, which some believe is still too early to tell whether it's going to reflect the full impact of those duties?
Yeah, I think it is too early to sort of hang a victory banner as it relates to tariffs' impact on inflation. I'm not terribly worried about what we might get with PCE, because once you have the combination of CPI and PPI, you can map the components therein to PCE, which is why that report doesn't tend to be an outlier to the same degree that CPI or PPI can be an outlier. But if we have a benign reading, it could reinforce the narrative that, hey, maybe our concerns were all unfounded. I just think it is way premature to say that because we're only now starting to hear directly from companies in the consumer space, in the auto space, that are putting more meat on the bones of what is our price increase strategy. How much, if any, do we plan to take the hit in our profit margins versus pass on those price increases? So I think it's premature to suggest that, hey, it will permanently be nothing to see here in terms of inflation impact. And then, of course, next week we have the all important jobs report as well, which is being released a day early because of the 4th of July holiday. And that'll help, I think, try to frame what the Fed's next move is. We don't think it's going to be a cut in July, notwithstanding what Waller and Bowman believe is appropriate. We think the earliest you might anticipate a cut would be it's the September meeting, but the job market certainly holds a key to that.
It's all about that dual mandate. 4.5 minutes to go to the close. I'm just wondering what your steer is on these markets, given that we are in arm's length from certainly record highs for the S&P 500, and how you've particularly been looking at retail trading participation.
Yeah, I think to use generally more trader lingo, I think the pain trade is still higher. I think what's happened in the course of this move up off the April 9th intraday lows is it does have the retail traders' fingerprints all over it. Notice I didn't say individual investors, specifically talking about that retail trader cohort that grew out of the pandemic, and they still very much have a buy the dip mentality. And you see it in terms of segments of the market that have outperformed on the way up, including baskets like retail favorites and meme stocks. And maybe interestingly, even more interesting is the fact that another area that has outperformed on the way up has been heavily shorted stocks. That is suggestive of the retail trader sort of initially powering this move higher and almost forcing the institutions to reposition a bit away from that risk-off stance. And that involved short covering on the way up. I would say that institutions, for the most part, have not gone risk on mode. They kind of left risk off mode. They covered a lot of shorts, and maybe they're in some neutral range, which is part of the reason why I think the pain trade is probably still higher. But if we were to see institutions and the retail trader move to that more frothy, pure risk on, then that complacency narrative becomes more of a high froth, higher risk narrative.
Great. Okay, got it. Thank you so much, Liz Ann. It was an absolute pleasure speaking with you today. Let's do it again.